At Express EconGeoFinance Insights, we focus on the forces beneath the headlines, and few forces in modern finance are more misunderstood than quantitative easing. You hear the term everywhere, but most people don't actually understand what quantitative easing really is. Every time the central bank expands its balance sheet, the phrase quantitative easing gets thrown around. Fear spreads, optimism spreads, confusion spreads even faster. But here's the reality. Most of what people are calling quantitative easing today is not quantitative easing at all. To understand what's really happening, you need to step back from the noise and look at structure, how liquidity actually moves, when emergency policy truly begins, and why asset prices behave the way they do. Once you understand this, you stop reacting emotionally to headlines, you stop chasing narratives, and you start seeing the system clearly. So let's start with the foundation. Quantitative easing, often called QE, is not normal monetary policy. It is a last resort tool. At its core, quantitative easing is large-scale asset purchasing funded by newly created bank reserves. This is not physical money printing, no cash trucks, no paper bills. Central banks create digital reserves, balance sheet money, and use those reserves to purchase government bonds and, in extreme situations, other financial assets. Regardless of how policymakers describe it, the result is the same. It is large-scale money creation. And in real-world terms, it is inflationary. Quantitative easing only appears when everything else has failed. Historically, central banks begin with interest rate cuts, then forward guidance, then liquidity facilities. QE only enters the picture when rates are already near zero, financial stress is severe, and something inside the system has already begun to fracture. This is not about economic fine-tuning. It is about survival. That's why quantitative easing became a defining feature of the 2008 financial crisis, and why it returned again in 2020. When the financial system approaches failure, central banks step in as buyers of last resort, not to stimulate growth but to prevent collapse. So what does real quantitative easing actually look like? This is where most people get misled. Today, we are seeing balance sheet expansion. And yes, that is liquidity positive, but balance sheet expansion alone does not equal quantitative easing. Calling everything QE ignores a critical distinction. What we are seeing now is early intervention. Stress is building beneath the surface, the plumbing of the financial system is tightening, cracks are forming, but the full-blown crisis phase has not yet arrived. True quantitative easing does not arrive early. It arrives when policymakers have no other choices left. It shows up after credit markets freeze, after liquidity evaporates, after something breaks badly enough that systemic failure becomes a real risk. That is when you see massive asset purchases, multi-trillion-dollar liquidity injections, and aggressive balance sheet expansion designed for one purpose only, to stop the system from imploding. That is real quantitative easing. Now, let's talk about what happens next, because once QE begins, liquidity does not flow evenly through the economy. This is one of the biggest misconceptions in finance. Newly created liquidity does not go straight to households. It does not immediately raise wages. It does not first show up on Main Street. It enters the financial system first. Primary dealers, repo markets, money market funds, sovereign bond markets. These institutions sit closest to the monetary spigot. They receive the liquidity first, and they don't hold it. They deploy it immediately into financial assets. That's why asset prices rise before consumer prices. That's why markets move long before inflation shows up in daily life. Quantitative easing compresses yields across safe assets. Cash yields nothing. Bonds lose purchasing power. Safety becomes expensive. In this environment, capital is not simply encouraged to take risk. It is forced to. Institutions cannot afford to sit in cash during QE without guaranteeing losses, so capital rotates outward along the risk curve, into equities, into credit, into real estate, into private markets, and eventually, into the highest beta assets available. This creates a predictable sequence. Liquidity enters the system, yields collapse, capital is displaced, risk assets absorb the flow. This is not speculation. This is structural capital displacement, and this is where digital assets enter the picture. Crypto is the most liquidity-sensitive asset class in the modern financial system. Unlike traditional markets with slower capital rotation, digital assets respond almost instantly to changes in global liquidity. When quantitative easing begins and rates approach zero, capital is forced outward, not by optimism, but by necessity. Nothing sits further out on the risk curve than crypto. That's why digital assets amplify QE effects more than any other asset class. They absorb liquidity faster, they reprice earlier, they front-run policy shifts. This is why crypto often moves before equities, before housing, and before inflation data confirms what's already happening. At Express EconGeoFinance Insights, this is the lens we use. We focus on liquidity first, structure second, narratives last. Quantitative easing is not a bullish or bearish signal by itself, it is a signal of systemic stress. It stabilizes markets in the short term, but it does so by forcing risk-taking and weakening fiat currencies over time. We are not in full quantitative easing yet, but the early signals are forming. Understanding this cycle allows you to stop reacting emotionally and start positioning strategically. Stay informed, stay liquid, and stay focused on the forces beneath the headlines. This is Express EconGeoFinance Insights. If this helped, like and subscribe to Express EconGeoFinance Insights and comment below.